All right, welcome back for part three. More on dividends. So, dividends are a distribution with respect to stock. These are not payments uh, based on a shareholder being an employee, a creditor, or a vendor, or anything different than that. Again, if they're out of E&P, which is earnings and profits, they're a dividend. And note that throughout this, the character is not retained. So if a corporation generates tax-exempt income, dividend from the E&P related to that tax-exempt income is taxable as a dividend. So the dividend taxation to the individuals that receive it is taxation generally is at capital gains rates currently or qualified dividends rates. That's typically 15 or 20% to the individual dividend recipient. And 20% is for single and married filing jointly taxpayers that are over a certain dollar amount. You can go find the 2018 capital gains rate tables if you're interested in what those are. But in order to receive this lower preferential rate, it must be a qualified dividend. So only a domestic corporation or a special foreign corporation, if it satisfies specified criteria, which is basically that it's owned by a U.S. parent, can also issue a qualified dividend. And you must satisfy a holding period requirement in order to have a qualified dividend. So you must have held the stock for more than 60 days in the 120-day period beginning 60 days before the stock's ex-dividend date. So for those of you that are unfamiliar with this, a stock's ex-div date is the first date on which a share with respect to which a dividend has been declared is going to be sold without the buyer being entitled to the dividend. So, well, I tell you what, let's just walk through an example. So on September 25th, a corporation announces a dividend of $3 payables to shareholders of record on October 3rd that will actually be paid on October 9th. So if we look at the little timeline that I've scratched up here on the slide, we'll see the dividend declaration date is September 25th. The ex-div date is typically the day before the record date because most trades take a day to settle. So what happens is the ex-div date represents the date in which the buyer will not receive the dividend. If you buy it after that date, then what happens is the dividend is going to be paid to the shareholder that owned it before then. So you would be the shareholder of record on the 3rd because of the delay, and as a result, you would get the dividend paid. So if you look at the top, you can see what happens to the stock price, right? If there's a $3 dividend baked in, then what happens is the nanosecond after you're no longer eligible for that dividend, then the stock price is going to drop by $3 because it is now worth $3 less. Now, arguably, there's a small amount of time value of money baked in, but because the ex-div date, the record date, and the dividend pay date are typically pretty close together, that time value of money is almost immaterial. But technically, it wouldn't be a full $3 for a $3 dividend. It would be like $2.97 or something like that. Okay, so what we're looking for is in order to have qualified dividends, you have to have owned it for any 60-day period that includes 60 days before the ex-div date and 60 days after the ex-div date. So including the ex-div date, 121 days. So any 60-day period in that window would be okay. It could be the first 60 days. It could be the middle 60 days. It can be the 60 days after. It's just it has to be for at least 60 days. Okay. So what about corporate shareholders? Well, corporate shareholders get no special rates at all. They're all taxed at corporate tax rates, which are now a flat 21%. However, we know that corporations receive a dividends received deduction, right? So we've kind of walked through this already. I'm not going to beleaguer it. And it's based on the ownership percentage that the stockholder has in that subsidiary corporation. So it's either these days a 50, a 65, or 100% DRD. Okay. So why would anyone even pay or not pay dividends? Right? So what about if you have the option to retain earnings for future investments? Well, that would be one reason not to pay dividends. If you think the corporation can reinvest that money and receive returns in excess of what the shareholders could do with it, then of course the right idea is to retain the earnings for future investment. You could reduce borrowing costs through the retention of earnings, right? So if to the extent that part of this company is capitalized through debt, you retain that money and you pay down the debt with it. And presumably, therefore, the equity shareholders benefit largely because their ownership is at lower risk of default and their stock becoming worthless. So you could pay out earnings for closely held corp shareholders, but in a deductible form, right? So that's one reason why you would not pay a dividend, right? Is there some way to get those payments out, but in a form that's deductible? And that's for individual shareholders, right? Because a corporate shareholder will just take a DRD. But an individual shareholder might be saying, well, look, I don't like the double taxation. Why don't you pay it out to me in rent? Why don't you pay it out to me in compensation, or pay it out to me through interest? And you could have institutional shareholders that don't pay taxes, right? So if a pension plan holds your stock, then why would you wait? Why wouldn't you just pay it out in dividends? Because a pension plan is a tax-exempt entity and pays no tax at all. So another option would be what better use of capital do you have with distributions that have been made to shareholders? So let's say the company doesn't really have a good net present value project to entertain. Well, then the idea would be, well, why don't I give it to the shareholders? They can go invest in some other company that does have that opportunity. So, these are the things you got to consider when you're thinking about corporate dividend policy. So when we look over time for dividend yields, and a dividend yield represents the dividend you would get annually over the stock price, and then typically it's some sort of average stock price, but you can do leading dividend yields and after, ex post dividend yields. But in any event, these I'm pretty sure are average numbers. So the dividend yields on the S&P 500, you can see, can be volatile, but some of that volatility is associated with stock price increases and decreases. If you look kind of in the Great Depression, you see that dividend yields went way up. That wasn't necessarily because companies were paying fatter dividends. It was largely because stock prices plummeted. And so if the yield represents the annual dividend divided by stock price, if there's a stock price movement south, then you're going to pick up a bump in dividend yield. And you can see that dividend yields over time have gone down. And, some would attribute that to the notion that what's going on is dividends are simply less popular. So part of it is they're subject to double taxation. There's a preference for debt because debt creates an interest expense deduction on the part of the corporation, and so it's not subject to double taxation. But you can see that we've had kind of a trending down over time sort of scenario, especially going back to, the 1800s. Okay, so if you look at dividends per share for the S&P 500, you'll note that they're actually going up, right? But inflation is eroding away part of that. So what's happening is as the dividend is going up, the stock price must be going up by a greater amount. So we have this a little bit of a misleading figure, right? That says, look, dividends per share are way up. Everyone's paying more dividends. Well, not really. And inflation is a big part of that. Okay, so here's comparing dividend yields to, let's call it the 10-year Treasury yield, right? It doesn't have to be that. And you can see that dividend yields have slowly crept down over time. And, I'm sorry, you should say that 10-year Treasury yields have crept down over time, whereas dividend yields have been hovering around 2% for a good long while. But look at the spread between the dividend yield and the 10-year Treasury. Look how over the last 20 years or so, that spread has dissipated down to nothing. So as interest rates were ratcheted lower and lower and lower, they basically came down to meet dividend yields. So if you think about this, and I'm not a stock picker, so I'll let the investment management people decide whether this makes sense or not. What's the difference between dividend yield and treasury yield, right? Especially when treasury yields are quite low and arguably dividend yields are low too. Well, if as interest rates go up, the price of your bond, your existing bond, goes down. So there's an inverse relationship between yields and prices, yields in the market, I should say, and prices. And so what might happen is you end up holding something that the price is going down, and you're continuing to hold a bond that pays you, 1%. The upside to stock dividend yield is that, in theory, and this is all in theory. Again, I'm not a stock analyst. You have an upside potential on stocks right now. The idea being, well, look, if prices go up, then inflation goes up, and these non-monetary assets may float up with it. So you might see some return above and beyond what you would see on treasury bonds. But again, I'm not a stock picker, so I would not believe a word I say. So there are 86 stocks in the S&P 500 that don't pay a dividend at all. All 30 of the stocks in the Dow Jones Industrial Average do pay dividends. The average yield is about 2.67. And about half of the NASDAQ 100 pay a dividend, with the average yield being about 1%. So clearly, younger, more nimble companies, the idea would be they have greater net present value opportunities within the corporation, and they're far more likely to roll that investment back inside and use it to continue to grow, whereas a more mature company is far more likely to pay out dividends. Okay. I'd actually say this might be a good place to stop before we get to the next part. So I'll see you in part 4. It's going to be a little bit longer, I think.